Thanks for watching the MoneyShow.com video network. My guest today, Jackie Ann Patterson. Hi, Jackie Ann.
Hi, Karen.
Let's talk about exit strategies. Why are they important?
Well, I think the exit is a very important time in the trade because that's when we get paid. As a trader, that's the moment when the money officially flows into our account and is ours to either trade again or spend. So thinking about strategically when you're going to exit and how long you want to stay in the trade and what sort of signals you're going to take to get in and out of the trade is very important, and it's a very key piece to getting paid out of trading.
Is it different for investors versus traders?
Yes, I really think it is. I think that the time frame, the mindset that you start out with has a big effect on the type of exit strategy that you'd like to use. Certainly if you're entering the market with an idea of holding a position for over a year, getting favorable long-term tax treatment, you're going to want to do something different than a swing trader. And if you're a swing trader entering the market and you want to get gains not after a year but after 1 day, 4 days, so that's going to prompt you to think about exits a little bit differently.
What are the key elements of a trading strategy?
Well, I think there's two really big key pieces to a trading strategy and to an exit strategy in particular. And one is how do you handle losses? When do you cut losses short? What sort of method will you use to limit your loss and be able to preserve your capital and your peace of mind in order to be able to trade again? So that's one side. The second side, I think, is how to capture gains, when to take profits. And it's important to think about that also as part of the exit strategy.
How do you suggest limiting the losses?
Well, I think there's a couple different ways to limit the losses. As far as exit strategies go, looking at a particular point, a particular price, whether you set that in the market as a stop loss or keep that in mind, that's one way to do it. The other way is to have a particular signal. If the conditions change, that could be another way to limit losses. If somebody has, for example, gotten in when price has been going up, has been passing moving averages, if price starts going down, passing those same moving averages, that might be a signal to get out, even if the position has not yet become profitable.
And ringing the cash register, taking those gains.
Yes, I think it's really that's the happy part of trading, and it's also a part that may not get as much attention as it fully deserves, to think through what sort of situations will be the time to ring the cash register, to get a paycheck. Does a person want to set a target and exit when the price reaches a certain point, whether that point is a dollar amount or whether that's a certain configuration of indicators, or is a person more inclined to let winners run and do something, say for example trailing a stop along with the price as the price goes up, to match that with a trailing stop price, and in that way protect profits using a stop as well as limiting losses.
So you have to kind of match it to your personality, your style?
Yes, I think that's really a key thing, is to match the exit strategy to your trading style and to your personality and to your temperament. And that will kind of give you a boundary of the different sorts of exits you might consider. For example, the long-term trader might be more interested in strategies that let the winners run and go on longer, versus a short-term trader might be more interested in setting some very near-term targets and taking profits. But within that context, I think it's also important to understand the trading strategy and understand the potential performance of the trading strategy, and use that hard data to make decisions about which strategy might work out best for you.
Jackie Ann, thanks for your insights.
Okay, thank you.
My guest has been Jackie Ann Patterson. You're watching the MoneyShow.com video network.